Alright guys, so let's talk about the UK today. Over the past few months, we have been getting rather dire news. Now, first was the gilt crisis where the government bonds almost took down pensioners. Then we have the Bank of England sitting on a big pile of losses, but now the entire British economy is about to enter a recession. In our lead story today, UK economy shrinks in the third quarter, raising the recession risk. Q3 GDP shows a contraction of 0.1% while Q2 has been revised down, showing no growth at all. We can see negative growth from July to September, while April to June has stayed flat. We have gone from stagnation down to an economic crash, and this puts the UK just one quarter away from an official recession. Remember the textbook definition of one. Two consecutive quarters of negative growth equals a recession. Now, unless they redefine this away, the UK is about to enter one. Q4 is already off to a horrible start. In October, the British economy shrank by 0.3%, and they blamed higher borrowing costs and the wet weather. Things were looking bad because it was raining cats and dogs. They blamed the weather, guys. But here's the grim reality. What we are seeing is the deadly lag effect that's hitting London. High interest rates are taking down the UK, and they're just one whisper away from a disaster. Of the entire G7, the UK has the second slowest recovery from the 2020 lockdowns. The only economy worse than them was Germany, and it's a really low bar if you're comparing yourself to the Germans, right? And because of high interest rates, people are getting squeezed in their mortgages, so they're consuming less. Companies also can't access cheap credit anymore to grow, and when you throw in the reality of a slowing global economy, the United Kingdom is struggling to survive. If we look at the latest output in October, every single sector in the UK contracted. Services are down, construction has crashed, and manufacturing has dropped. There's literally no bright spot in the British economy today. The UK is the sixth largest economy in the world. We already have China slowing down. Japan's also contracting, and Germany is deindustrializing. So global demand's about to shrink even further, which spells doom for the world at large. And if we look at the unemployment data, it looks pretty grim as well. While it's only 4.2% today, we need to consider the trend. Unemployment has increased by 13,000 from the previous quarter and up by over 200,000 on the year. So more people are losing their jobs at a time when inflation is still high, while mortgages are still going through the roof. So it doesn't really take a genius to see where this is going. Now, 6 months ago, we made a bold call. We took a look at the British economy and we called for a recession back then. Inflation was just too high, and there are just too many structural problems in the country as well. And now a recession is starting to manifest. So let's talk about the British consumer, right? Just like in the US, many developed countries drive growth through their domestic consumption. In 2022, household consumption in the UK accounted for 60% of the country's GDP. So if the consumer goes under, so does the UK economy. They are both joined at the hip. And I have grim news to report. The British consumer is getting squeezed not just by higher rates, but by inflation as well. Now, Rishi Sunak proudly claimed to have slashed inflation by half from a year back. Yes, headline CPI has indeed fallen from 10.7% down to 4.2%. So it looks like he succeeded. But this isn't a victory because the numbers show that households are still paying much more money for lesser goods. From the latest CPI report, we can see where this big drop came from in November. Transportation costs have fallen by 1.4% compared to a year ago, which dragged down the CPI numbers. However, if you look at housing and food, inflation has barely moved there. Food is still sky high at 9.2%, while housing is still up at 5.3%. Most people's paychecks they go towards food and shelter, so the consumer is still getting squeezed. And this means cutbacks are coming. It's just a matter of time before consumption crashes even further. The headline metric might be improving, but it's just not fast enough to prevent a recession. According to the ONS, UK consumers are spending more money to buy fewer goods. The value of retail sales is going up, but the actual volume of products received has dropped. So instead of paying £2 for a gallon of milk, you're now paying £2 at 40p for less than a gallon. This isn't a sign of a strong economy, it's a signal that consumers are still getting screwed, and the gap between this disparity is getting bigger over time. But it gets worse. Costs for public transportation are also flying up. Rail fares are heading up by almost 5% in the UK next year. In March 2024, British people will be paying more to take the rail, higher than the inflation rate today. So consumers are still going to feel the pinch. If you're going to face higher costs for your essentials down the road, you'll be saving more today and you'll be cutting down on spending. There'll be very little incentive to head out and splurge on a new bag or a fancy new car. Now, the British Chancellor, Jeremy Hunt, he's upbeat about wages. He has raised the minimum wage and is declaring victory over inflation. But that is only one perspective. By investigating deeper, it's clear that the British consumer is still horribly weak. Adjusting for inflation, real wage growth came in at 1.2%. So there is indeed a return of real spending power. It's positive. But look at the collapse in real wages since December 2021. British workers suffered 20 continuous months of negative wage growth thanks to inflation. In other words, their buying power dropped for almost 2 years straight. This collapse in growth is essentially the lag effect from lower real wages. Reality is finally starting to bite. Now, on one side, consumers are hurting and more price increases are coming. And for the other 40% of GDP, the global economy is slowing down, so British exports are in deep trouble as well. Now, back in 2017, the former Bank of England governor gave an ominous warning. He warned that the UK would depend on the kindness of strangers to survive and support the currency, and his prophecy is becoming increasingly real today. Because of the UK's economic stagnation, the pound is also at risk of long-term devaluation over the dollar. Remember what currencies are. They are colourful coupons used to exchange for goods and services. And as the UK economy contracts, this puts pressure on the strength of the British pound. If the UK can't produce more goods and services, people will be less willing to hold the currency. They can just hold dollars instead, right? So it will be worth less and less, which is a big problem for inflation going forward. Over the past 10 years, the pound sterling has been dropping against the dollar. It has crashed by 33%, going from 1.7 in 2014 down to 1.27 this year. It's a fall year after year, which shows you an absolute decrease in demand for the currency. And this isn't good for the British economy and the entire country as a whole. It makes it less attractive for investors to come in and pour their money into. And this will trigger a deadly cycle of devaluation where inflation goes up, but asset prices could indeed suffer. Listen to this. If investors find it less attractive, UK assets would fall in value to induce people to invest more, so the exchange rate will fall further. And this isn't good news for the people in the UK. More and more pieces of the country will be sold off for cheap to foreign investors. And because of Brexit, the UK is now cut away from the common market, or at least it's much harder for Britain to do business with the Eurozone today. And this has sparked an exodus of investment money out of the UK. In 2021 and 2022, there has been a big collapse in capital flowing to the country. This is undoubtedly bad news. Lesser investment means slower growth, and that translates to fewer jobs and an economy that will stagnate. So you can kind of see the big headwinds that the UK is facing today. It's not just because of high inflation, but an accumulation of wrong decisions made in the past. Another worrying concern for Britain is the government debt. From Bloomberg, slow-growing UK faces reckoning over £2.6 trillion worth of debt. The country now has hit 100% debt to GDP for the first time since the 60s. The issue here is the debt servicing cost. Because the British government sold a ton of inflation-linked bonds, the interest payments have gone ballistic. Compared to the developed countries and even the US, Britain has the highest debt cost around. It went well over 10% of government revenues in 2023. In other words, the UK is going broke and it's happening rather fast. This isn't the British Empire anymore. There are no colonies paying taxes or tribute to the crown. Those days are over and Britain has to rely on their own economy to escape this mess. They also can't print money like the US to escape the debt. They don't hold the world reserve currency. Monetizing the debt will just collapse the pound even further. But if we listen to Rishi Sunak, there's nothing wrong with the British economy. According to him, the UK is the best place in the world to invest and to do business in because of their low tax approach, culture of innovation, and the British people. Now, call me cynical, but I fail to see the competitive advantage the UK has. Inflation and interest rates are still too high. If I want to manufacture stuff, I'll go to China. They have cheap energy from Russia. And if I need a banking hub, I can always head to the United States. They have Wall Street and it's kind of better than London City. Even the tax situation in the country isn't that great. Sunak has raised the corporate tax from 19% to 25% from April 2023. You're supposed to lower the tax rate to bring in companies and not raise them. So it kind of doesn't make sense on paper. And that's why this is going to have big political spillovers for the Prime Minister. If the British economy enters recession, he might even lose next year's election. Looking at the polls, we can see an absolute collapse in support for the Tories while Labour is starting to grow. And the chasm is wide, a 22-point difference, which shows a big dissatisfaction with Sunak's government. Voters are becoming increasingly angry with the state of the UK, especially when it comes to the economy. Pulling up Sunak's report card, voters are slamming his performance across all categories, from reducing inflation and growing the economy to reducing the debt and NHS waiting lists. Every single score has gotten worse. If a recession is declared, then Sunak might soon join Liz Truss and the new Prime Minister might be heading to 10 Downing Street. Now, I'm not an expert in the British economy, but there's one glaring problem I need to point out, and that is the state of British exports. The UK has to think like an emerging economy now and get their exports back on track. The balance of trade here highlights a glaring problem. Over the past 5 years, the UK's trade balance has been mostly negative. In other words, there's a trade deficit building and is growing bigger. The UK is consuming far more than what they produce. The UK's biggest export is its services, coming mainly from the banking sector. However, other sectors like manufacturing, they are languishing hard. They are stuck in a quagmire because the expertise and the money aren't just there, they're not coming in as well. Now, this is an interesting chart that I need to share. It shows you the true state of the British economy and how skewed it really is. Wealth in the UK is concentrated mainly in London. If we take away the richest region in the UK, we get a living standard of around $39,000 per capita. That's lower than Germany, the Netherlands, and the US average. The standard of living in Britain is lower than many of their peers. In fact, outside of London, the rest of the UK is as bad as Mississippi, which is the poorest state in the US. So that's a big eye opener for everyone, myself included. Now, I don't want to end things on a doom and gloom note. Can the UK dig themselves out of this economic hell? I believe it's possible, but they have to take smart steps. Now, firstly, I believe that a recession in 2024 is almost unavoidable. It'll take a miracle to dodge one next year. The lag effect is already dismantling the British economy. But if the UK aligns themselves with the right partners, they will be able to grow their industries and sell to bigger markets. You have to throw your chips in with the rising economies. According to the CEBR, by 2038, the top economies in the world will be primarily Asian. China will be in the top spot, the US at number 2, and India will be number 3. Three members of the G7, the US, Italy, and Germany, will be sliding down the rankings as well. And this means the UK has to build stronger economic relations with both the United States as well as China. Playing politics now is dangerous as China continues growing in economic power. Getting Chinese money to the UK is just as important. Selling to Beijing is also crucial to increase exports. You need to sell to a country with enormous buying power. It's really a no-brainer, right? You align yourself with economies that are growing fast, China and India, especially one that will take the top spot down the road. And that's probably why David Cameron was called back as Foreign Secretary to repair ties with China. Whether this works or not remains to be seen. Wang Yi has won the UK over sanctioning Chinese companies, so the ball is in Britain's court. Now, the UK will likely enter a recession in 2024. The chances are very high. But whether things get better in 5 or 10 years down the road depends on how well Rishi Sunak plays his cards today. But let me know what you think. Will the UK fall into recession? Is there any way out of this mess? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.